Ultimate Trader Reddit, Nathan from Queens, April 8th, 2022, state of the market. Well, at least I can say that rates are probably going to rise just one more time. Right now, we have rates at 4.83. We might not get a lot more than one more rate hike. That is because the issue with the banks, where a lot of banks, unfortunately, they took deposits, and a lot of these banks lent out to venture capitalists, angel investors, tech companies that do not make cash. So when they have the deposits, they need that money immediately. So the banks took these deposits and they bought 10, 20, 30-year treasuries because they were earning higher interest rates. And the interest rates that were earning were like 2% or even below 2%. But mind you, 2 years ago, even last year, we had a Fed funds rate that was 0.125. So January 1st of 2022, we had a Fed funds rate before rates kept flying at 0.125. So in order to earn a lot of money, you had to, if you want to do treasury bonds, which a lot of banks did, you had to do 20, 30-year bonds. But what the banks didn't foresee, and they should have, is the banks were regarded. They were regarded and thought the Fed were going to pivot or they were going to stop. Around April of last year, that's when the curve started to invert. So an inverted yield curve means that you start earning more money on a short-term bond, like on a 6-month bond or a 1-year bond or a 2-year bond. Once you start making more money on a 1-year or 2-year bond over a 20 or 30-year bond, you got to start selling those 20 or 30-year bonds to hedge just in case something is going on, because the market, the bond market, the credit market is telling you something is going to happen with rates. So instead of doing so, they let it invert more. They let rates keep going higher, and they didn't sell those bonds. So just put it this way. This is the easiest way to describe it. Okay, I bought a bond. I spent $100,000 to buy a 30-year bond, earning 2% interest. 2% interest. So you're not going to get the principal for 30 years. So you're not going to get back the 100,000 for 30 years. But every single year, you're going to earn $2,000 because you got a 2% rate, a 2% coupon on that bond that you bought. But right now, people can get 2%. Well, they were able, like a month ago, they're able to get 5%. 5%. And only invest on a 1-year or a 2-year. So if I can make $5,000 with $100,000 for 2 years and get my principal back, guess what? Your $100,000 that you're not going to see that earns $2,000 is going to go down in value. So I'm not trading bonds, but I would say that $100,000 bond that you had is worth maybe $70,000. Unfortunately. So you're going to lose $30,000 because you're not going to get that money back for 30 years, and each year you're earning 2%. But if you want to sell that bond to get rid of it, to have some other sucker hold 30 years, they're going to buy it back for like $70,000. So the only reason I'm saying going through all that is now a lot of the banks are in trouble. 4 banks fail. You had the first bank that fell was a Silvergate. You had SIVB, Silicon Valley Bank. You had Signature Bank, and then you had Credit Suisse. It was not New York, but those 4 banks failed, and believe it or not, a lot more banks are in trouble. Because I did try to look at mark to market on the balance sheet. You can just see how much money a bank is down, but I can't see it on balance sheets that you open. If it's in 2-year bonds, 10-year bonds, 20-year bonds, and what price they're in, because you need to find out, how much they're down on what bond. Is it easy? Because you want to get an idea. Is it easy to sell it, and at what loss? Can they take a small loss? But we're not going to get into that. But the reason why the hikes are not going to happen so much is we don't want to really crush the bank's value on what they own, because a lot of the banks buy the treasury bonds because the treasury bonds are safe. They're very, they're dependable. So you buy the bonds. So now a lot of the banks are in a credit crunch, and when they're a credit crunch, they do not want to loan out money. So the Fed rate is going higher and higher. We're at 4.83. We're probably going to get one more hike that takes us about 5.1, and the Fed might stop because the banks are not going to be loaning out that much money because the banks are in trouble. So a solution for the banks is to start giving 1 or 2 year CDs at 4.5% or 5%, so that they don't have to borrow from the Fed, so they can get instant cash, or give 2% on deposits in your bank. I don't know if they're going to do that, but that's a solution. People are discussing that. But going over that, because of that, at least we might be almost done with the rate hikes. Now, we have earnings coming this following week. Right now, it's estimated that earnings are going to be down between 5 and 8% on S&P 500 companies. So if it's already estimated the earnings are going to be down 5 or 10%, why on earth is the S&P 500 going higher and higher? As it stands for the full year, Nathan from Queens, Ultimate Traders on Reddit, has the S&P 500 earning $208 per share. And that's as of now. And we haven't had the first quarter reports, because you're going to see how close I'm going to be. Because before, in 2020, January 1st of 2022, I had the S&P 500 earning about 220. I ended up lowering it to 214, 215, and right now we're at like 218. I can actually go check, because I think all the numbers are finalized, and I think the S&P 500 is tracking at 218 for 2022. So I'm saying in 2023, earnings are going to go down fully about 208. That's where I have it at. And if earnings are going to go down, earnings are down 3 to 5% for the full year. You shouldn't. The S&P 500 shouldn't be trading over 16 or 17 times. So even if we give 17 times 208, we're still at 3,600. So I have no idea why we're so high, but I don't want a piece of it. So at least we're gonna have rate hikes stopping soon, but earnings are coming down. Watch out. We got earnings coming next week. Sales are gonna come down. Generally, like I said in the last video, or all the videos that I have, the S&P 500 trades at 18 times earnings, 17 or 18 times. And to do that, stocks on the S&P 500 are growing sales at 10 to 20%, earnings at 5 to 10%. So take out your report cards, start grading earnings, check those numbers year over year. You're going to see, you're not going to see too many companies that are growing sales at 10 to 20, earnings at 5 to 10, and the S&P 500. You just take a look. And when you just take a look, how are you going to give the S&P 500 20 times earnings? Because right now at 4,000 and change, the S&P 500 at 4,000 change, I have earnings at like 208. So earnings right now, the S&P 500 is trading at 19 and a half earnings. No way. It should be 17, 18 and normal times, and this is not normal. So good luck to you. No FOMO here. I'll sit and wait.